Over the past few years, I've traded a number of trading approaches, but 3 of them seem to have worked the best. I'm going to share them with you here in this video. If you want to see me do this live every day for free, you should join my free Telegram channel. It's the first link in the description of this video, and I've been running this channel for the past 6 years, just live trading, sharing my analysis, my insights, things like that. Now in this video, I'm going to teach you how the mechanics of these actually work. So let's go ahead and get straight into it. You'll notice that on every single chart, regardless of which market you trade, price tends to just go up or down. The 3 trading approaches that I've developed over the course of the past few years revolve around this simple idea that price does just in fact go up or down. The first trading approach is dollar cost averaging. A lot of people would call this something like grid trading or a pseudo martingale approach, as you use a multiplier and start adding positions. Essentially, if anything goes into drawdown, and then whenever it comes back into profit, you're able to get out in profit most of the time or break even. The second approach is mean reversion. It's just waiting for the market to go really far in one direction, entering a trade that counters the market, and then hoping that it just turns around and goes into profit. And the final trading approach is trend trading. Now, we're going to look at all of these in as much detail as I think is reasonable for you to grasp the basic concept. One thing that you have to understand is that trading is extremely nuanced and it is complicated no matter how simple you attempt to keep it. I do my best to keep things as simple as possible, which is why I don't really have any clear black and white trading strategy. I don't use just one exact specific trading strategy. It is just a component of just looking at the totality of the circumstances, accepting all the nuances and subtleties, and using my experience to do what I think is best given the context. So let's look at the first trading approach. The way I'm going to teach you this is by practicality. The practicality will be, again, if you want to see this, just go to my Telegram channel. First link in the description, you can see it live. But I'm just going to teach you the concept here in TradingView replay mode. So what I'm going to do is I'm going to pick a random pair. And with that random pair, I am just going to scroll back to a random point on the chart. That way we can see what happened. So 1, 2, 3, 4, 5. This is a random pair Euro USD. I'm just going to scroll back. Literally, I'm going to use the replay function where you can just click the random bar. This takes us back to January of 2018. Now, the first thing we'll look at is we'll look at dollar cost averaging. Now, I'm going to be the first to say that whenever you're trading, everything is super contingent on your subjective experience. There is nothing you can do, even if you persistently try to do things in a 100% black and white way if you're manual trading. This is why it's important to just accept the fact that there is a lot of uncertainty and accept the fact that your decisions aren't always going to be the exact same thing for every trading opportunity. This is okay. It's not something you should run away from. It's actually something you should gravitate towards, because the better you develop your skill set of trading, the more consistently you will be able to rely on those feelings and intuitions and discretion and the discernment of the price action to actually make your trading decisions. It is also a very free way of trading in a sense that you don't have to stick to any rigid black and whites. You can do what you think is best based on the specific context and the specific trading opportunity, instead of clinging to things that you believe are absolutes when they are in fact not. So the first thing I'll do here is I'll demonstrate a DCA trading approach. So this is Euro USD. We'll go to the 1 hour chart. That way just things can play out a little bit quicker. The 1 hour chart for all these trading approaches is a good place to start. If you go to time frames like the 1 minute in a market like Forex, it is a little bit difficult because of the volatility, in my very humble opinion. And if you go too high on the time frames, like the weekly chart or the monthly chart, sometimes things can just take way too long, quote unquote, and you might be leaving money on the table had you just checked the time frames that were a little bit more in between. I like the 1 hour, the 4 hour, and the daily, and I kind of put all these things together in tandem. Now, the simple approach to dollar cost averaging is to just use a deposit size you're completely comfortable losing, and then trade a small position size. So what we're going to do is we're going to simulate that there is $1,000 in this account, and we're going to use a position size of 0.01 standard lots. This is represented in 1,000 in terms of quantity. This is also represented as just saying it's a micro lot. So effectively what you're doing is you're waiting for the market to go somewhere where you think it might bounce, and then you're essentially starting a position that is very small. If it goes into profit, you close it wherever you think you should close it. Your reasoning does not matter. Just close it in profit whenever you think it's gone into enough profit. And then if it goes against you, you just add to the losing trade. One important caveat here that is immediately noticeable is that with a dollar cost averaging trading approach, eventually you're going to blow the account. Now, I want to say this first and foremost, there's nothing wrong with this. This is why you start with a small balance. For example, if you have $10,000 that you want to trade with, and you're comfortable allocating $1,000 to this specific trading approach, you can simply fund a $1,000 account. That is 10% of your trading capital. And you can accept the fact that eventually you're going to blow that account. However, the idea is that most of the time, that's not going to happen. It is going to be very rare that you blow the account if you're doing it in a way that the risk is structured very small. The idea would be that you're able to double the account and then withdraw it or internal transfer the profits to another account within your brokerage, and then double the account again and again and again, knowing that you can still blow the account at any moment. However, most of the time, you'll be relying on the fact that that's just unlikely to happen. I'll give you an example. Let's say you start a $1,000 account, just like we're doing in this example. And over the course of 1 month or 2 months or 3 months or 6 months, you're able to double the account. And then let's say you start another account and you double it again. And then you start another account and you double it again. And the fourth time you try this, you end up continuing to add to a losing trade using dollar cost averaging. It completely keeps going the quote wrong way, and then it just margins out the account. You essentially blow the account and lose the entire starting balance. That means you would have tried to do this 4 times, and 3 of the accounts you would have blown, but 3 of the accounts you would have grown, and then 1 of the accounts you would have blown. This means that 75% of the time, with that small amount of data, you can consistently grow an account to the growth target, which is doubling it. It's a good place to start, and you can change it if you see fit. That means that of the 4 accounts you started, there was a total of $4,000 put at risk in total. You made $3,000 on the 3 accounts that grew in profit, and then you lost $1,000 on the account that blew. This means that you've made $3,000 minus $1,000, so you still came out on top $2,000. As a portion of a profitable portfolio of trading approaches, dollar cost averaging works as long as more than 50% of the time you can double an account before then internal transferring the profits or withdrawing it and then starting again with a fresh starting balance. I want to point out, you will blow an account doing this, but I also want to stress that that is okay as long as more often than not, meaning more than 50% of the time, you can grow an account to at least double it before you withdraw. Then you can decide if you want to grow it to tripling it or quadrupling it or more before you withdraw in the future. That's all up to you. I find that doubling the account is a good rule of thumb to kind of stick to because it means that you're just protecting profits. The moment you double one trading account, you withdraw the profits, you're starting again with your original balance, which means that the money that you're risking is just quote unquote on the house. It's money that you've already made in profits and you've protected your original starting balance. So with that caveat out of the way, let's get into it. I'll show you a few trades. Dollar cost averaging is one of the easiest trading approaches because you don't really have to do any work. It doesn't matter which way the market goes. You're simply profiting from the volatility. So we will start a 0.1 standard lot sell, and then we'll just say we'll add if it goes up here, and then we'll add again if it goes up here, and then we'll add again if it goes up here. The idea is that you're very unlikely to blow the account, but you're extremely likely to have most trades end in a net profit. You'll notice price went up here to this next area, but due to the fact that we're in TradingView replay mode, I didn't pause it in time to close in a profit, so I was unable to do that. We'll just set a profit target here, and if it goes back up, we'll just add to it there. A lot of this requires a lot of patience. You're free to do this on any size trading account, and you're free to do this on any time frame. If you're doing this on this time frame, It's the 24th of January. This is now the 4th of February. So this has been about a week that you would have been in this trade, and it's just going sideways. I went ahead and just added up there, and we'll see if this gets to the profit target. So this trade ended in profit. You can see it grew $32. This is about 3% of the account. And remember, you're effectively risking 100% of the account on every trade. We'll do a couple more trades and I'll show you how this works. What we will do is we will say that we're going to just buy here. Again, it doesn't matter where you buy or sell. All that matters is whether or not you're able to use small enough position sizing and add at enough of a quote grid, which just means just the distance between all your entries. We're able to just add at enough distances in order to profit from the volatility. A good rule of thumb with dollar cost averaging trading approaches is not to add too close together. For example, if this goes right there into drawdown, it probably, in my opinion, wouldn't be the best spot to add because the market really hasn't had a snap really farther in the same direction for you to get a quote better entry. If you're adding positions too close together, it's almost the same as just using a bigger position size and starting a position around that same price. With dollar cost averaging to work, and you'll learn this through experience, it's usually best to just let a little bit of distance occur between the entries based on whatever relevant time frame you're looking at before adding. This allows you to profit from the fact that the further the price moves in one direction, the more likely it is to have a reversion. This goes contrary to what a lot of people say about trend, which is that the more the market continues in one direction, the more likely it is to continue in that direction. There's nothing wrong with this logic if you're looking at an asset like the S&P 500 index, or maybe the real estate market in most first world countries. These things continue to trend upwards over time. This is not what I'm talking about. I'm talking about in a market like the foreign exchange currency market, where there in most cases is no clear long-term trend. And I just say that as a subjective opinion. Price goes up and down, and it's affected by all sorts of fundamental and technical factors. In this market, it is generally the case, in my opinion, that the more price goes in one direction, the more likely it is to just have a pullback. It doesn't have to be a full, complete reversal that extends for 1,000 pips, but the more price goes in one direction, the more likely there just is to be a reversion in price. So with that logic, it allows you to profit from whatever occurs. So this trade concludes in a profit. It was $10, so about 1% on the account for the original starting balance. What we'll do is we'll do 2 more dollar cost averaging trades. Every now and then you will get into trades that just continue to go really far in one direction. And again, these are the ones that will blow your account. The idea is that you'll get better over time at kind of picking where you think the market might be likely to reverse at. Then you'll start positions there. Then if it goes against you, you'll just add to the losing trades. And you'll accept that if you're using small enough position sizing and a big enough grid, meaning a large enough distance between entries, that most of the time price will have a reversion and you'll be able to get out of most situations on either break even or loss. Again, it should always be remembered that you will eventually blow the account, but that's okay, provided that you're able to double the account most of the time. So the market went to this next area where we'll add at. So we'll add a trade right here. And then we'll wait for it to go up to this next area. And if it does that, we'll add there. Market goes to the third area that we've added. So we've added the third trade. What I'll do is I'll say if we get up further up into here, we'll add a fourth trade. It would also probably be a good idea here to adjust the profit target to be more realistic. The further price goes against you, the more likely it is to go to the original profit target that you would have set. And again, there is no specific in how you can set these targets. Some rules of thumb would be, it's probably not the best idea to set it really far away, right? You can look at the chart, you can see where the market's been going up and down. And setting it somewhere here would probably be unrealistic. But by the same token, it's probably not a good idea to put the profit target like, 5 pips in profit or something like that. You want to be realistic and you don't want to be unrealistic. You'll learn over time what is realistic and unrealistic, because you'll learn that if you set your profit target too close, you'll have very quick winners, but you'll be sitting in drawdown like 99% of the time, because most of the time you'll have that profit target hit, but it'll be a really small winner, and then you'll have significantly more drawdown. But then again, you don't want to have the profit target so far that you're waiting months for trades to play out. They're going in drawdown, they're ranging, they're back and forth. You'll learn kind of what a reasonable profit target is by simply getting experience. The simple place to start is just close the trade wherever you want. You'll see what happens afterwards. Maybe the price continues into a lot more profit, or maybe you'll notice that you're setting your profit targets too quick or something like that. You'll learn this with experience. To start, just close the trade in profit wherever you feel like. So we'll keep this at the previous low here for now. Okay, so this ended in profit. We could have closed earlier in profit. We could have closed at break even. In this case, we held it here. We could have held longer. The reasons don't really matter. This trade made about $50 in profit, if I remember correctly. And there was a total of 3 trades total. So the first entry and what's called 2 quote-unquote recovery trades, or DCA trades, meaning just the acronym is dollar cost averaging trades. This one ended in profit. So far, we've grown the account 8%. And we will do one more trading opportunity. What I'll do is I'll buy here. And we'll kind of just pre-plan what the quote-unquote grid will be. So we'll add if price goes to this second and third area. You'll notice they're not really tight together. There's a little bit of distance. I've just kind of looked at what the market's been doing. It goes up and it goes down. I've just given myself some room to kind of add so that way we can capture the volatility. It would also be wise to set a profit target. We'll set one up there. Okay, so the price has gone to an area. Looks like I just missed the entry, but we'll add anyway. Price went to the next area where we'd add. Put right there, then I'll adjust the profit target to these previous highs just to be a little bit more reasonable. So that profit target hits. It made it a little under $20, so almost 2%, right? 18 bucks. So at this point, the account has been grown 10%. It's also important to point out that you're not just going to be trading one asset at a time if you're doing this. You can trade multiple. You just need to make sure that the account balance is big enough and the position sizing is small enough to account for whenever you have drawdowns of trades going into back-to-back drawdowns. There are plenty of times where you're going to get 5 recovery trades, 10 recovery trades, 15 recovery trades deep. It is not uncommon for the account to be in a 10, 20, 30% drawdown or more at any given time as you wait for a mean reversion to occur that gets you out of a trade in either a net profit or break even. It's important to consider these factors as to determine whether or not you want to use this as one of your trading approaches in your portfolio of strategies that you might use. So we could go into more, but in the interest of time and not wanting to make this video 10 hours long, I'll go ahead and stop here for DCA, and then I'll say that you can go and test this on your own. Now, the next trading approach is mean reversion. Mean reversion is essentially just waiting for the market to go really far in one direction, then entering using a fixed stop loss and a fixed profit target. For me, it's generally a 1-to-1, and then risking whatever you're comfortable with, letting the stats play out. In order for mean reversion to work, if you're using a 1-to-1 reward ratio, you have to really wait for for price to go really far in one direction before starting an original or your initial position. Now, there's no adding to this on mean reversion. You can do like a hybrid DCA and mean reversion approach if you want. So you can say like, I'll start a position here. Then if it goes against me, I'll add. Then if it goes against me even further, I'll add, and you'll have a fixed number of positions you're willing to add before a final invalidation, at which point you'll close all trades at a loss if that occurs. So there's multiple ways to do this. what I'll do in the interest of time is I'll just keep this very simple with a 1-to-1 risk reward ratio and a fixed profit target and fixed stop loss and a set risk for every single trade. This is not how I actually personally do this in real life, but I will do this as a model to teach you a good place to start. That way it's actually useful. If I tried to employ and teach you the exact way that I implement it whenever my approach to mean reversion trading and the executions of the trades I actually take, what will likely occur is you'll just get confused and you'll say, why did he do that? Or why didn't he wait for this and that? I want to be able to teach you this in a way that it is simple for you to go out and experiment with on your own. So I will show you a great place to start, in my opinion, while still telling you that trading is risky and most people lose money, and you're probably going to continue losing money even if you listen to everything I say. So with that said, let's get into DCA. We'll go ahead and use the same currency pair for DCA. Actually, no, let's just start fresh. So on 1 to 10, we'll pick number 7, so that's 5, 6, 7. This is GBP CAD. We'll click random bar, and this takes us to June of 2017. What we'll do is we'll use the 4-hour chart. You can use any time frame, but I want to use a time frame where it captures a little bit more data. Generally, the lower you go with mean reversion trading using a fixed stop loss and target, the less likely the outcome is to occur. I find the higher I go, 1 hour, 4 hour, and daily, it just seems like the outcomes are more likely to play out. But then again, the trade duration does increase. My average trade duration using mean reversion in this way is about 2 weeks to 1 month, meaning in that ballpark range, it is very uncommon for a trade to take less than a week or two to play out, but it is also very uncommon for me to sit in trades for 2 to 3 months. They generally play out within a deviation of 2 weeks to 4 weeks. So with that being said, let's get into it. The idea is to simply wait for the market to go really far in one direction and then counter the market with a fixed stop loss and fixed profit target. So essentially what I will do is I will just be using my experience to say whenever I think the market has stretched quote unquote far enough, and then I will enter a trade to counter the market. A big portion of this is just being patient. So what I'll do, I'll start with one standard lot, then we'll kind of drag the TP and stop loss out. So this will be 1-to-1 risk reward ratio, 4,900. And we'll say that I risk, let's say $12,000 on this for the potential to make about 12,000. I'm actually going to tighten this up a little bit. We'll risk 10,000 to make 10,000. And then I will not mess with the stop loss and profit target. However, I will close early if I feel the trade is no longer likely to play out in my favor. A lot of this requires a lot of patience. This trade was the 13th of July to the 22nd of August, so about 1 month, and then it resulted in a stop loss. So then what I'll do is I'll simply take the next trade, and then we'll see what happens. This one's kind of frustrating because I got very close to the profit target before then stopping out. I'll essentially wait for it to go to the downside a lot more before deciding whether or not to enter. So it looks like the move finally played out. I did not capture that move, and that's okay. Not every trade is going to be a winner. I'm just waiting for the market to move really far in one direction before trying to capture the volatility. What I'll wait for is kind of like a final spike up somewhere. And then if we can get another spike upwards, I will sell. So we do have a spike upwards. I will sell right here. I'm going to set the profit target and stop loss at a location I think is reasonable. Yeah, this seems pretty reasonable. So I'll essentially risk about $10,000 to make $10,000. And then we'll just let it play out. So in this case, it does play out. Price goes directly to the profit target. And you'll see we're roughly break even. So far it's been a 50% win rate. In order for this to really play out in a sense where the stats can actually play out to have an edge, I would need to take maybe 20 to 30 to 40 trades. In the interest of time, I won't be doing that. I'll just be taking a few trades just to show you the proof of concept. That way you can then employ this in your own trading, and you can essentially test it to sort of figure out all the nuances and subtleties and the kinks. You're essentially just waiting for price to move really far in one direction. Now, what exactly does that mean? There's no black and white rules. I understand this could be frustrating for a lot of people because it does feel a lot better to be able to trade with black and white rules, and it gives you a sense of false security. I say that it's a sense of false security because it's not actually security in reality. In reality, the only thing that's going to make you profitable as a person that is manual trading, meaning you are the one making the decisions and it's not automated through the sense of an algorithm or an automated trading strategy, the only thing that will make you profitable is your discretion. It is your subjective discernment of price action and your experience and your intuition and your feelings and your thoughts and emotions that are going to help you decide what the best thing is to do given the context. There is nothing that can allow you to get past this. There is no shortcut for this. There is nothing that can be done to speed up this process except for simply getting more experience. Trading is like any skill set in life. The more you do it, the better you get at it. The better you get at managing your emotions. The better you get at placing trades. The better you get at predicting what is likely to happen. I'm going to take a mean reversion trade here. Set the stop loss there and the profit target here. This is, it's a little more than $10,000 risk. It'll be about $11,000. So, but you get the point, just in the interest of simplicity and time. I'm going to set it up like this and we'll let it play out. So this one is stopped out. However, I think that this is another separate mean reversion trading opportunity because price very quickly has continued to stretch in one direction. So I'm going to take another sell up here. This will be its own trade based on its own merit, its own criteria. This will be $4,500. So 9,000. I'm going to tighten this up just a little bit. Same situation, about let's just say $12,000 to make 12,000, just in the interest of time and not wanting to be specific about the position size. About 12K to make 12K. So this has went down. That opportunity fell to the profit target. Like I said, in the interest of time, to really show the stats play out and prove that it's past a 50% win rate, because you effectively need higher than a 50% win rate to get past swaps and commissions and all that types of stuff if you're trading with a one-to-one risk to reward and waiting for trades to hit the profit target or the stop loss. In the interest of time, I don't want this video to be a 10-hour long video, so I'm not going to continue. I've taken 4 trades and I've shown you that it's at least break even with this microscopic data set. The idea is that you now have something that you can take to go and test. If you're able to even just break even in trading, meaning a 50% win rate with a one-to-one risk reward ratio after taking 30, 40, 50 trades, then you are doing better than most traders. How many traders? I don't know. Maybe 90% of them. 90% or more of people, from the statistics that I've looked at and the metrics that I've seen and the studies that I've reviewed, 90% or more of traders lose money. If you're able to break even, you're at least not losing money. If you enter randomly on the charts with a one-to-one risk reward ratio, you are likely to have half of them hit the stop loss and half of them hit the target, and you're likely to be a break-even trader, net of swaps and commissions. If you do this and you just test it out and you try mean reversion, you just try to hit a one-to-one risk reward ratio more often than not, and if you're able to just break even, you're doing better than 90% of traders in my opinion. And if you're able to move that win rate to even just around 60% or 65% or 70%, you have a profitable trading approach. The way that you trade does not matter. The story you tell yourself about why you take trades does not matter. The reasons you give yourself and the narrative surrounding those reasons does not matter. What matters is you getting enough experience to say, this seems to be a good trading opportunity to me. Now I'm going to participate in it, and I'm going to do it with a risk management structure that I'm comfortable with. Whether that's dollar cost averaging, or using stop losses, or grid trading, or hedging, or martingaling, or anything else, it does not matter. What matters is that you define the risk, you understand the implications and the potential consequences of the risk management. We could say the risk management approach or style or structure that you're using. As long as you're comfortable with the risk and you know what the risks are, you can participate in whatever trading opportunity you like. Just make sure you know what the risks are and you accept what that is. If you're using DCA, the risk is that you're eventually going to blow the account. If you're using stop losses, the risk is that you lose that dollar amount if trade goes to the stop loss. Now what we're going to do is we're going to move on to the final trading approach, which is trend trading. Now, there's no strategy for trend trading. We'll go here to random.org, select a random number. So 5, so it'll be Euro USD again. This is April 2018. We'll hit random bar and go somewhere else. The thing with trend trading is that you can use moving averages. You can use channels. You can use trend lines. You can use Fibonacci. You can use support resistance. There's a lot of different ways to do it. In my opinion, a simple way to approach trend trading is to just look at the chart on whatever time frame you want. You can use a lower time frame or you can use a higher time frame. I think the 1 hour is a good place to start because it's not too small of a time frame where the granularity and the texture and the nuances can be very volatile. And it's also not too quote unquote large of a time frame where you're trading on the monthly chart and a couple candles is a couple months and then you're waiting a very long time for the trade duration to occur. In my opinion, the 1 hour is a nice place to start, but feel free to experiment with whatever you want. It's your trading approach and it's your experience that's going to get you profitable. So feel free to experiment. Now, essentially what we'll do is I'm just going to wait for the market to look like it's getting into a trend. Now, if you were using a DCA approach or a mean reversion approach, you could start just adding sell positions in here. But as a trend trader looking at it from that lens, I don't see a real place to get in because I don't know where the stop loss would be. There would need to be some sort of a place that you decide you're going to get out at should the market go against you. What I'm going to do is I'm just going to wait until it looks like the market is in a clear trend, and then I'll get into a position. We'll see which way the market looks like it's going to go. Looks like we're in a range right now, so I'm just going to kind of leave this alone. Looks like the market might be going up. So this could be, it could fall back down and fail to continue. But for right now, this looks like it'll be a perfectly acceptable place to get in to a trade. We're going to use one standard lot. I'm going to drag this out and see what the risk will be. We'll say it'll be $65, but I'm not going to place a profit target. I'm going to kind of wait and see if price can go into profit and then determine what to do at that time. If this loses, it'll be $65. If it wins, we don't know how much profit it'll be. And the stop loss, the reason I put it here is just because it was underneath this previous low. So if price breaks that low, the idea would be that the price is no longer trending and it would probably be a good time to get out. So the market hit the stop loss. It looks like the trend is not continuing up. It failed to break the highs. That was a stop out. That'll be that. I don't want to say this is a downtrend yet because it could just be price going sideways. At this point, it still looks like to me like it could be in a range, bigger picture, so I'm just going to leave it alone. So it does in fact break the low, barely. We do have a pullback. Now we're kind of casted further up into this range. So now it looks like we do have enough bullish steam for this to be considered an uptrend again. I'm going to wait for a pullback. I just find the best way to trend trade is to wait for a pullback. By getting in on the momentum moves, it's just really hard to see, like, to figure out where you're going to put your stop loss at. I'm going to wait for a pullback. Now I'm going to get in here. I'm going to put the stop loss right under this most recent low. This is a pretty tight stop loss, but it's fine. It'll be underneath these recent lows. If it stops out, we'll just move on to the next opportunity. If it goes into profit, we'll see what we can do. I'm going to wait for it to pull back a little bit and then try to add to this. It pulled back a little bit, then started to go into profit. What I'm going to do is I'm going to add up here. I'm going to put the stop just under the recent lows, and I'm going to keep this amount of risk. This was the original where it started at, $60, $70. The risk is now $164. The idea would be that the fact the market is showing evidence it's likely that it's continuing into profit means that we're just more likely to continue up, just because it hasn't broken the lows and it looks like it's trying to break the highs. A lot of this is really subjective and contingent upon experience. You'll have to get this experience to make these kinds of decisions. Again, there's no specific strategy. It's just the general approach that matters. It's the approach of saying, if something's in a trend, I'm going to try to participate and capture that movement from the trend. So this has started to go into profit. I think that since the price has moved far enough in this direction, I just think there's likely to be a movement here downwards. So what I'm going to do is I'm going to close the trade there in profit. Now, if this was your actual trading account and you're using multiple different trading approaches, what you could now do is you could start getting into like a DCA trade on Euro USD. You could either use the account that, you're sure you're going to blow at some point. It's a small portion of your trading capital. Then you could enter a small position size, then just continue selling if it goes a little bit further against you. Then the moment they all go into profit, you could just close it wherever. Or you could do a DCA trade right now where you enter a sell. Then you put your stop loss way up here, your profit target maybe like, somewhere down here, be a 1-to-1 reward, you make it play out. However, this trend, we've already caught that movement. Sure, it could go further up and sure we could miss out on some profits. However, the more price goes in one direction, the more likely it is to revert. After a big move in one direction, I prefer to wait for a pullback and simply get back in. So we'll see what happens. The market pulls back. You could argue that you could have maybe got into a buy right there, but it's always a could have, should have, would have type of thing whenever you're trading. We'll just say we didn't get to any trades. We're going to wait for a pullback to see if we can get another entry. So prices pulled back. I think that we've gone so far in one direction, it's likely to continue down. But in the interest of trend trading, I'll still buy here, put a stop loss underneath these lows here, and then see what happens if it starts moving into profit. I don't see a good spot to add at the moment. So it does make a higher high. In this place, there was no spot to add that I personally saw. Maybe once you start doing this and experiment, maybe you'll get a trading opportunity in which you see something that you're like, okay, I could do that and I could make that work and I could add there and this and that. Then you can be comfortable with the risk. In this case, this made a higher high. Usually when this occurs, right, there's some sort of a pullback. I think it's a good time to close. So I'm going to close there. We'll do one more trading. We'll do one more trade. So I think that this has pulled back enough and that it's still in the context of an uptrend that I will buy. And put the stop loss below there. You could have put it all the way beneath these lows, but that's kind of far. I'm just going to put it down here. Take profit. We'll just go ahead and leave the profit target open. So the fact that we've kind of struggled right here says this might be less likely to work out. For some reason, this is just all intuition, right? It's just my experience. I just think that the best decision right now might not be to try to hold this. You have to keep in mind that when you're right, usually price just goes instantly up. You buy, it goes instantly up. You buy, it goes instantly up. The fact this tried to go up, failed, went into some drawdown, tried to break the lows, almost hit the stop, then went up back into profit. This just tells me that the likelihood of it ending at the, maybe a higher high within the context of the trend is just less likely than originally anticipated. So I'm going to decide to just close this one here. And then just for curiosity, we'll see what happened afterwards. This goes down. The stop loss was here. That might have hit the original stop loss. We'll see what ends up happening. Looks like it's trying to go up at least, right? Still kind of in a range. All right. What I likely would have done is close it at the previous high. I don't know if that would have hit the original stop loss, right? The stop loss was somewhere down here. That might have hit the stop loss, or it might have not. In any case, one of three things would have happened. The first thing, the trader would have hit the stop loss. The second thing is price would have gone into profit and you could have closed at the previous high. Maybe you hold to a higher high, whatever. But the third thing that would have happened regardless if you had stayed in the trade is that the trade duration would have been exceptionally long. In my opinion, holding a trade for this long as it ranges and goes sideways, it sort of nullifies and diminishes the idea that price is still in fact in a trend. If you enter a trade and you call it a trend trade, price should move into profit, in my opinion, relatively quickly. If that doesn't happen, it probably means that the market is just no longer trending, at least for that specific moment, and that the better decision would probably be to just elect to close the trade. If that happens to be a small loss or a break even or a small profit or a big profit, so be it. But if the market is not quote unquote trending, it's kind of hard to justify staying in a trend trade. Now, this concludes it. I've taken a fourth trade. I've tried to do like 4 trades on each of these examples. This concludes the video of showing a dollar cost averaging approach, as well as a mean reversion trading approach, as well as a trend trading approach, and how you can actually go to the chart to facilitate gaining the experience to see these things in action. Again, if you want to see me share my trading insights and analysis and stuff, you can follow my free Telegram channel. It's at the first link in the description. If you've made it here to the end of the video, you're one of the small percentage of people that actually makes it this far. Just do me a favor and hit the like button if you want and if you found it useful. I'll see you in the next one, my friend. Cheers and happy trading.